guys. I am excited today. I have Travis Vincent from Overcome. Super excited to have you on, Travis, one of my longtime friends, fellow Boston Celtics fan. So excited to have you on today. How you
What
doing?
up? What up, Boston?
Let's go. Travis, you've been killing it, man. These last 3 weeks, protected over 50 families in these last 3 weeks. I'm sure that's been a fun last couple weeks for you, seeing those deposits hit and starting the year off right.
Yeah, it's definitely a lot better than not seeing those deposits hit, that for sure. So it changes a lot of things for sure. Decisions you can make, which is pretty cool.
Yeah, that's awesome, man. I'm happy for you. So trying to help out new agents. What obviously, because again, you've diversified, you've done a great job of that. I remember getting started, I did a really poor job of putting all my eggs in one basket. You've done a good job of diversifying your lead flow to obviously allow you to write that much business. What are the kind of like the lead sources that you've been using?
Yeah, so I think I use about there's like four different sources I use. Well, five if you count annual reviews, because obviously I've been in the business long enough to where I can reach back to people that I talked to like a year ago. But the current lead sources, I have some mortgage mailers. Everyone knows what those are. Those are usually like you lock out a county and homeowners that just bought a home are filling out mailers. I have the IVR or the mortgage call-in leads. I work a lot of those as well. And then, of course, do some second chance as well. But I think my favorite lead type is definitely the mortgage protection social media through StrongPoint. So I
For
think between those four lead vendors plus my annual reviews, that's really where the revenue is coming from.
Okay. So kind of dive into the digital mortgage leads. What have those kind of been like through Strong Point?
Yeah, so those are I feel like they're newer, but they're completely different. So like what I was used to doing, obviously because I've been in the business now a couple of years, the IVR, the call-in or the mortgage mailers, you're basically a homeowner that just purchased a home or did a refinance or getting a mailer in the mail that they're either calling into or they're just like filling out and returning. Whereas with the strong point leads through social media, they're not necessarily new homeowners. They're people that are on social media, Facebook, Instagram, TikTok, whatever. And they see a video that goes into great detail about like what mortgage protection is. And this client essentially is basically clicking on the link and filling out all their information and requesting an agent to call them back. So it's definitely different. Like I said, it's not a new homeowner. But what I love about it is like I think the intent is the highest I've seen on any of my other lead types for sure.
Yeah. What I love about it, because I remember a couple of years ago when the mortgage dried up, like it was like, we all kind of hit the panic button because we're at the mercy of the market, right? In the housing market. So when
Yeah.
that is where all your lead flow comes from, and when that dries up, what do you do? Then you're scrambling around to try but it's there's something about mortgage leads where you get generally a healthier, higher quality client because
Hmm.
their income's there. There's a lot of things. Again, they have a mortgage, so they're not like, generally living paycheck to paycheck, a little better situation, right? So I
Right.
think that's huge by being able to have, instead of having just the current people buying houses, it now opens you up to the whole United States of anyone that has owned a home, watches a video. The intent is super high. And obviously it's another tool in your tool belt that you can add for your lead flow to give you
Yeah.
that good solid mortgage base of clients that you're looking for.
Yeah, yeah, and I think because yeah, I remember early on in the business, when I was a new agent, I started with final expense, right? So final expense, it's great because like there's no shortage of people looking for final expense, right?
Yeah.
But like you said, with final expense, you're usually dealing with people that are either generally really struggling health wise, or the budget's really tight. So then, of course, we get into mortgage, but then now it's market dependent, right? You got to find a county that you'd have to lock out that another agent doesn't have, and then you're just hoping that the market's doing well. And so, like, think like to the point that you just said, I feel like with these strong point leads, right? I'm getting I'm basically getting the same volume as you would with final expense. Like, there's no shortage of homeowners in America because it doesn't have to be a new homeowner. But then I'm also on the other side getting generally a healthier client with a little bit more expendable income. So
Yeah.
I think it's like the best of both worlds for sure, which is why I like them.
Love it. So I guess like with any, because I remember when I started going after and setting up the call-in mortgage leads, I just had a learning curve that I had to kind of figure out, and it took me 2, 3, 4 weeks to really get a good grasp on it. What was like kind of your initial one through week 4 of using the strong point leads? What was that like for you? Kind of adjustments you made along the way?
Yeah, because and like you said, it's like any lead type. I remember when I was brand new, it took me a minute to figure out final expense, and then I had to figure out mortgage and then call in mortgage. The same thing. There was definitely a learning curve. I think it took me a few weeks, and by about week like 3 or 4, I was starting to find something that worked. I think what I find works for me with these leads, well, two things. Well, first off, you really gotta work the lead, meaning you can't just call them one time and expect that they're just going to answer. Again, any type of social media lead, typically you could really got to pound the phone, and for lack of a better term, blow them up, right? You got to find different ways to get in front of them.
Yeah.
It's dialing multiple times, calling at different times of the day. Also, texting I think is huge. I can't tell you how many times if I can't get a hold of them, right, I'll just text them. Like, hey, this is Travis. I'm getting back to you about the ad you responded to on Facebook looking for information on mortgage protection. I'm just the medical underwriter assigned to the case. When would be a good 10-minute time where I could grab you to kind of run through your options? And then sometimes, like days later, they'll text me back and like book an appointment via text. So I think it's just learning that you really got to work the lead. So don't be afraid to call them multiple times, meaning go back through the list that you have on the no answers. And I would definitely recommend texting all of them. One thing I do like about the strong point leads is they're all cell phone numbers. The way the vendor is vetting out like bad numbers and things, like you're typically getting, you're almost 100% of the time you're getting like cell phone numbers. So they're going to respond when you text them. And I think the other thing I learned, that was different than like traditional mortgage, is these are mainly a one call close rather than a booked appointment.
Okay.
With my traditional mortgage mailers, usually you're calling someone and you're just trying to book an appointment, get the spouse involved too. And then usually your appointment ratio, even over the phone, is pretty good with those. For whatever reason, again, I don't know the answer to this, but with Strong Point or the social media, if you book an appointment, let's say you finally get them on the phone and then book an appointment, for whatever reason, it's the no-show ratios are very, very high. So I think what I really figured out was once they answer the phone, now remember, it took me maybe a minute to get them on the phone because sometimes they don't answer right away. But once I did get them to answer, I just realized like, hey, it's go time. Like I
Yeah.
have them on the phone, they have a minute to talk, and I just start getting into my spiel and try to one call close. And I only book an appointment if they like interrupt me and say, hey, Travis, right now is not a good time. Can we speak later? Then I'll set an appointment from there. But I think the vast majority of my strong point sales are coming from the one call close.
Love it. Um, if you could walk me through, let's kind of do a quick role play. I think it'd be really powerful for agents that are starting to work these leads. So I think for newer agents starting to work these, there's going to be kind of a learning curve. So if I'm you and I'm starting with these leads, what I recommend is what Travis and I are going to go over, copy paste it. I think any good agent, if you want to have success in this business, copy paste what the top producers are doing. Travis is a Hall of Fame agent, um, sold hundreds of thousands of dollars in premiums, right? So I think it's important just to copy and paste what he says. I think in the next couple weeks, or next week or two, Travis is going to come up with a script, right?
Yeah, for sure.
These four agents, so love it. So let's kind of walk through. If you want to do like a one call close with me and just kind of like go through the whole process, I think that'll be really helpful for a lot of agents.
Yep, yep. So the first thing I do is before I even call you, and I just want to preference this so new agents understand, is I'm going to shoot you my credentials before I even dial you one time. But I'll do it like 10 seconds before I call. So the idea is if you get a text message with my credentials, my state license, my name, all that stuff, now you're looking at your phone and then I'll call. And I find that's a great trick to get them to answer right away.
Love it.
So I've just sent you my credentials and then like literally like 10 seconds, now I'm dialing you. So ring, ring.
Hello.
Hey, Mike.
Yep.
Hey, Mike, this is Travis. I'm getting back to you about the ad you responded to on Facebook looking for information on mortgage protection. I'm just the medical underwriter that got assigned to the case. Now, a moment ago, I just sent over to you my credentials and a text message. You should have received both my driver's license and my insurance license. Did you receive that?
Yeah, they just came in a second ago. Yep.
Okay, perfect. And just want to double check and make sure that's a state requirement. You know, you need to know who you're speaking with. So feel free to keep that. That's a copy for your records. Now, Mike, are you familiar with mortgage protection?
No, I just saw the ad on Facebook, and so I filled it out.
Yeah, sure. Okay. Yeah. So I'm happy to elaborate, but bottom line, it's a form of insurance that would either pay off the home, pay down the mortgage, or in some cases, it might make monthly payments for a period of time to help aid in transition for a homeowner. And
Okay.
typically the homeowners would do it, you know, usually right after they buy or refinance a home. Now, my job is pretty simple. I'm just the medical underwriter that got assigned to the case. I'll ask you just 2 minutes of health questions. Reason for that, Mike, is, you know, unfortunately, not everyone is eligible for this type of coverage. Sometimes if you're taking too many medications or if you're unhealthy, that might disqualify you. And then I'll also ask just 2 minutes of financial questions because as important as this insurance is to have for a homeowner, it does not make any sense to be insurance rich and cash poor. So we do need to find something that makes good financial sense and doesn't take food off the table. But Mike, if I'm able to find a plan that you're healthy enough to qualify for, and then B, it's one that also makes good financial sense and fits easily into the budget, I'll help you submit a request for coverage to see if we can get you approved.
Okay.
All right. Any questions for me so far?
No, nothing so far.
Okay, perfect. And then from there, what I'm doing is I'm just jumping right into my financial inventory, and
Okay.
I'm just going to start asking about the health and mortgage questions. So that's kind of my opening right there for those type of leads.
Okay. So go through the financial inventory. What are you kind of doing after you have their full picture of kind of their situation? What does that look like from there to kind of the close?
Yep. So, and you're saying like I've already got the financial inventory. I
Yeah.
understand about your health, what your needs are. Is that what you're saying?
Yeah. Unless you want to go through the financial inventory, if you think that'll be helpful for agents.
Yeah, I'm happy to do it. If you want, I'll kind of do like a run through with you real quick.
Yeah, perfect. I think that'd be good.
Okay. So I'll kind of pick up where we left off. So Mike, any questions that you have for me so far?
Nothing so far, no.
All right, perfect. So Mike, I'm going to jump into my process. Usually this takes about 8 to 10 minutes. It's super quick, but I'll just jump right in and see what we could help you with.
Okay.
All right. So Mike, obviously we're talking about a mortgage.
Yep.
And then, do you know approximately how many years is left on the mortgage?
I think 27 years.
Okay. And 3 years ago, was that a refinance for you or was that a new purchase?
New purchase.
Congratulations.
Thanks.
Does it feel like home after 3 years or are you still bumping into the walls?
Oh yeah, it feels like home now.
Good. Again, congrats. And then do you know the value of the home, like what it got appraised for?
260.
Okay. So 260. And then what's the monthly mortgage payment?
1200.
Okay. Does that include like taxes and escrow and everything?
Yeah.
Okay. And if you had to ballpark, do you know like roughly how much is still owed on the loan, like the balance?
I think there is 180.
180 left on there? Okay. And then do you pay extra towards the mortgage to pay it off early?
Probably about an extra 100 to $200 a month.
Okay, it's a couple $100. Okay. And then thinking of your monthly expenses for a second, and I would include like, the new mortgage, let's say any car payments, phone, utilities, TV, internet, food, ballpark wise, what do you think it costs you every month just to maintain your current lifestyle?
I would say about 5,000.
Okay. And then Mike, how old are you?
36.
Okay. And what do you do for work?
Sales.
Okay. And what would you say your monthly income is after taxes?
I'd say 10,000.
Okay. And then are you taking any medications?
Nope, no medications.
Okay. Are you a smoker?
No.
Any surgeries for you in the past like 5 years?
Nope.
Okay. And Mike, I forgot to ask, are you single, married, widowed, divorced?
Married.
Married, okay. What's your wife's name?
Olivia.
Okay. And how old is Olivia?
33.
Okay. And then what does Olivia do for work?
She's a school teacher.
Okay. And then what would you say roughly her monthly income would be after taxes?
2000.
Okay. And then any medications that she's taken?
High blood pressure.
Okay. And is that like, I know a common one would be like lisinopril, amlodipine, metoprolol, anything like that?
Metropropyl.
Okay. All right. And is that the only one that she's taken?
Yeah.
Okay. Is she a smoker?
No.
Any surgeries for her in the past 5 years?
No.
Okay. All right. And then going back to you, Mike, I'm just gonna kind of run through some health conditions. Just stop me and let me know if you have them, but I'll assume they're all no if you're not taking any medications. But I'm guessing it's a no for heart attack, stroke, TIA, all those are no.
No. Nope. Nothing.
Okay. Any cancer, stents, diabetes?
Nope.
Okay. Any like neuropathy, lupus, or rheumatoid arthritis?
No.
Any asthma, COPD, or thyroid problems?
Just a mild asthma.
Okay, so probably like, what do you have, like a Bluterol, like an inhaler for that?
Yeah, butyrol. Yep.
Okay. And then any anxiety, depression, kidney or liver disease? No?
No. No.
Okay. All right, so main source of income looks like what you and Olivia are doing for work. Any other streams of income that would help you guys offset the cost of the mortgage if need be?
Nope. Just that.
Okay. And then, do you guys have anything like 401k, IRA, stocks, bonds, anything like that?
We both have 401ks.
Okay. All right. Any like significant savings laying around in a checking account or savings account?
Uh, Probably about 7, 8,000.
Okay. And if you had to like guesstimate on the 401ks, how much do you think you got saved up so far for retirement?
Mine will say 100,000. Hers 15,000.
Okay. And then do you guys have life insurance?
Yes, we both do.
Okay. Is that private or is that through work?
Private.
Okay, perfect. Do you know the name of the company that's taking care of you?
Yeah, Primerica.
Okay. And then do you know how much the death benefit would be if something were to happen?
Um, I think with both of us, we both have 250,000.
Okay. And then do you know when those end?
Um, they're for 20, we probably have 25 years left on them. So I would say, yeah, about 25 years from now, they're 30-year policies.
Okay. And then the cause of death or that would pay out, is it for natural causes? Is it only accidental? Do you know the details about that?
Just regular life insurance.
Okay. All
Yeah.
right. All right. And then do you have any like unsecured debts like credit card debt?
About, I'd say about 1,000 in credit card debt.
Okay. Any like personal student or business loans?
No, just a car loan and house loan.
Okay. Any like medical bills, timeshare properties, or collection accounts?
Nope.
Okay. All right. And if you had to guesstimate on the credit card debt, how much do you think you owe?
About 1,000.
Oh, okay. So, yeah, it's not very much. Okay. All right. So, and then, so that's the financial inventory. And now I'm going to transition and kind of educating the client on the product and like what options are. So I'll start doing that right now. All right. So Mike, this is always the most awkward part of my job, but of course, I wouldn't be doing it correctly if I didn't ask you. But based on what you told me, it looks like you're the primary income earner in the household. Is that correct?
That's correct.
Okay. So let's say, God forbid, something were to happen to your health. again, maybe it's like a critical illness like heart attack, cancer, stroke. Maybe it's just like a permanent disability. It could be like from a car accident or something horrible, but bottom line, you are unable to go back to work and provide an income. What would that look like for you and Olivia as far as trying to pay the mortgage and maintain your current lifestyle?
Yeah, that'd be pretty tough.
Okay. Do you think you guys would be able to keep the house and keep paying the mortgage, or do you think something would have to happen?
Um, yeah, she'd probably have to go live with her parents.
Okay, gotcha. Okay. All
So,
right. Now, obviously, if we could find a way that that would never have to happen, I mean, that's probably why you're looking into mortgage protection. Is that fair to say?
yeah, exactly.
Okay. And again, super awkward thing to ask you, Mike, because I know we just met maybe 8 minutes ago here over the phone, but obviously, as my job, I think I ask 30 homeowners that same question a week.
Mhm.
But again, this is the reason to have mortgage protection. It's just to make sure that if anything were to ever happen, let's say to your health, even while you're still living, well, at least from a financial standpoint, the house is either paid off or your income is replaced. They say the only thing that's worse than dying is surviving a critical illness, right? Because between all the medical bills and loss of income, that's typically when a homeowner would lose the house. And this is what would prevent that from happening.
Okay.
Now, Mike, the way mortgage protection works, it'll act a lot like life insurance, meaning if you did get approved for it, it'll be attached to you and your physical person. It actually would not be attached to the loan or the house. And I
Okay.
like to explain that because let's say if you ever refinance down the road to get a better rate, you're not going to lose the coverage. Same thing if you ever moved, right? Not a betting person, but you and Olivia are pretty young. There's a good chance that this is not your forever home. Well, the good news here is if you guys do sell and buy something else, well, this protection would follow you. Much like regular life insurance, as long as you're paying the monthly premiums, well, then the coverage is going to stay active.
Makes sense.
And they do it this way really for your protection, to make sure that, hey, it's a one-time thing. Like once you have it, you don't have to worry about ever doing that again because now you have it for the next 30 years. Um, Also, too, the way they do it now is all these programs are non-medical, meaning they're not going to be sending out a doctor or a nurse to do a full physical.
Okay.
They actually stopped doing that after COVID. How they do it now is they just pull all your medical records. So they'll look at anytime you've been to the hospital for something major. They also look at anytime you've been prescribed medication. And then usually it'll take them a couple of days up to a week for them to figure out whether or not they're going to approve you. Now, if they do approve you, which is great news, they then will give you 30 days to make your final decision.
Okay.
And that means a couple things here. You can move the coverage up if you and Olivia decided that you guys wanted more coverage. You could also move it down if you're trying to lower the monthly premium. Or to be honest, they'll allow you to make any changes you want to, no questions asked in that 30-day window.
Okay.
So all that to say this, that nothing's going to be set in stone today, but what we'll try to do today is we'll try to look for a plan that you're healthy enough to qualify for, and then one that actually makes good financial sense and fits easily into the budget. And then from there, I'll help you submit a request for coverage to see if we can get you approved. Does that sound fair?
That sounds fair.
Okay, perfect. So here's kind of how it works, Mike. Let's say if you had the full mortgage covered, again, full mortgage is 180,000 is what you owe. So if you were to die or pass away for any reason at all in the next 30 years, well, then Olivia, she would receive 180,000 in a tax-free death benefit.
Okay.
So it'll act just like life insurance. Now, I know you do have the Primerica policy already. Now, here's why most homeowners would have both mortgage protection and life insurance side by side in the event of a death. Now, here's why. Let's say you did ever pass away, your mortgage protection policy would pay off the home for Olivia, And then your Primerica policy would replace income that Olivia was depending on, but you're no longer alive to make. So
Okay.
that would be the reason to have them both side by side. They do two separate things for you. But I think the main difference here is the living benefits. Because again, unlike the Primerica policy, that only pays out when you die. Again, good to have, definitely keep it. Whereas this would take care of you while you're living.
Okay.
So to explain that for a second, let's say, God forbid, you ever had a critical illness. So we're talking things like heart attack, cancer, stroke. If you ever ended up in a coma, trip to the ICU, kidney failure, liver disease. Again, you don't have to die from any one of these ailments. You just need to be diagnosed. But if you were diagnosed with something like that, well, now you would have access to the 180,000 that you could pull out of the policy tax free and use however you see fit.
Okay.
Meaning you could use that to pay off the mortgage, you could use it for medical bills, income replacement. What's important to know is, again, this is not PMI, so they never send it to the lender. They always are sending it to either you or Olivia. And just like regular life insurance, it never needs to be paid back, nor are they going to tell you how to spend it. But it just gives you guys, the homeowners, control on how you're going to use the funds in a horrible time like that.
Okay.
Same thing for any like permanent disability or a chronic illness. Now, a chronic illness, that could either be an illness or an injury. It really doesn't matter. It could be like a really bad car accident, again, like we talked about. But bottom line, what they're looking for is if you are unable to perform two of the major 6 daily living activities for at least 90 days or more, well, then same scenario, you'll have access to that 180,000 that you could pull out of the policy tax free and use however you see fit. All right.
Okay.
But the best part is, hopefully you never need this, right? Hopefully, Mike, you go the next 30 years and you don't die, right? Or become disabled or get critically ill. Well, I think the coolest part is they'll actually give you a full refund on all the premiums that you paid into it. They'll give it all back to you tax free when you turn age 66.
Okay.
So it's literally like a forced savings account for homeowners. Because if you think about it, you're not really spending any money, you're just saving it.
Mhm.
But rather than saving it through, like, let's say a regular bank account, you're saving it through an insurance company. That way, if anything awful happened, well, now they're just going to pay off the home. But I mean, if nothing happened, well, at the very least, you're getting all the money back right around retirement age. So it's kind of like a win-win.
Yeah.
Yeah, last thing I'll say about it, here's the easiest way to think of it. And here's what I teach all my new homeowners that I talk to. Let's say if today you made a decision that you're going to start saving $200 a month on your own, by the way, into a savings account, right? And the purpose of the savings account is to make sure that, hey, if anything happened to you and you couldn't go back to work, well, you'd have funds that you and Olivia could use to help you pay off the mortgage. And let's say you save $200 every month for the next 10 years. You're super disciplined, goes in there. Knock on wood, 10 years from now, something happens to your health and you need it. Well, in 10 years' time, if you were saving $200 a month, you would only have about 24,000 in a savings account that you could then use to help pay the mortgage, which, as you can imagine, these days, 24,000 won't go very far, let alone pay off your mortgage. Um, but on the flip side, let's say instead of putting that $200 a month into a savings account, you decided to put that into a mortgage protection plan. Same concept, because every month you have to save that. It has to go in there every month. The difference is in 10 years in that same scenario, again, knock on wood, we don't want it to happen, but if it did, you don't have 24,000 in your savings account that you can use, you'd have 180,000. And I think that's the main reason that most homeowners, myself included, would have mortgage protection, is because, let's be honest, I mean, in your greatest time of need, the lender who you have your mortgage through, they're not going to have your back. Doesn't matter what happens to you or Olivia, they just need to make sure that, hey, that monthly mortgage payment gets covered. My dad used to always teach me that nobody is gonna, take care of future you better than present you. And that's really what a mortgage protection policy is. It's just present you setting something up, so just in case, God forbid, if future you ever needed a bailout, you'd have it. And again, if you never needed it, well, good news is you're getting all the money back at retirement age anyway, and that's why we call it a win-win. Um,
Okay.
so Mike, I did a lot of talking, but what questions do you have for me about the way these plans work?
No, you did a pretty good job explaining it all. Makes sense.
Okay. And assuming that we do find an option that does make good financial sense and fit easily into the budget, do you think this would be important to have?
Yeah, I think so.
Okay. So here's what you'd be looking at. Here's a couple options, Mike. Let's say if you decided to cover the full mortgage, again, full mortgage would be 180,000. The funds required to keep a policy like that in force would be 200 per month. Now that's the full mortgage. Now again, not all of the homeowners I talk to do the full mortgage, and here's why. Remember that every month, as you continue to make mortgage payments, the balance of your loan keeps going down. But the way mortgage protection works is this coverage is going to stay level the entire time. Meaning, if you had 180,000 in coverage and something happened tomorrow, well, then yes, it pays off the home outright for you.
Okay.
But let's just say something happened in 15 years from now. Again, hopefully not, but let's say it did, right? Well, in 15 years, you and Olivia won't owe 180,000 on the home, yet this insurance would still pay out 180,000. So again, you may not need the full mortgage. That's up to you. So a lot of my homeowners I talk to will do half the mortgage, which to be clear, that's half the mortgage today. But in 15 years, that's actually the full mortgage.
Mhm.
Again, bottom line, it'll pay out 90,000 if you ever needed it. But that one's only 100 per month. Or Mike, you could just do the drop dead bare minimum. Bare minimum that I would recommend for a homeowner will be at least a third of the loan. Now here's why. Think of it this way, God forbid if something ever did happen to your health and it was compromised, well, at the very least, on a 30-year mortgage, the mortgage would be covered for the next 10 years.
Okay.
10 years is quite a long time to figure out finances, so I would definitely think that would be a responsible bare minimum. Bottom line, it pays out 60,000 if you needed it, but that one's only 70 per month. Um, Now, obviously, we cannot make a decision today anyway, just because I still don't know whether or not the insurance company would even approve you.
Okay.
But if they were to approve you, which option do you think would make the most sense for you?
To cover the full mortgage.
Okay, all right. And then at that point, Mike, I'm just right into the e-application. So I'm asking, hey, what's your date of birth? And I'm right into it.
Love it. Okay.
So that's kind of start to finish, intro, financial inventory, options, and then close.
Love it. And I love how you closed multiple times throughout that, even at the end
Mhm.
saying like, hey, if we can make this affordable and does that would that make sense for you, right?
Yeah.
And saying again before you show numbers of kind of teeing it up of like, hey, is this important to you?
Mhm. Yeah.
They kind of close those multiple times, clear, concise on what this is, how it works, no confusion. I think eliminating confusion as a new agent is so important. If you're confused on how it works, it's hard to explain it to the client and make sure they're not confused about it. Confused people.
Yeah.
So love
Yeah.
just bang, 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 right to the point. Not a lot of fluff, not a lot of building rapport, right? A lot of
Yeah.
agents, especially these type of leads, try to build too much rapport, and that hurts you. Get right to the point, help this family, keep control of the whole appointment, and then real simple close. Love it. That was
Yeah.
gold. So
Yeah.
yeah, anything else you would add to work in these leads?
Yeah, a couple things I would say just to kind of piggyback on what you had said is so the way I view this type of, I guess, sale, right, is the client they responded and they're asking for my help. So I immediately feel like, okay, I'm the teacher or instructor here or the educator, right?
Yeah.
So if you think about it, like if I ask someone for help, right, or I went to a class to learn, I, as the student, am not going to be talking a ton. The instructor is going to be basically telling me, they're going to get up there and speak in front of the class for 15, 20, 30 minutes, and then they'll ask questions at the end. So what I found early on when I was a newer agent is if there's too much rapport, too much back and forth, it's not really like they don't view you as the authority,
Mhm.
because now it's more of like a conversation back and forth. And I want them to view me as like, hey, you asked for my help. I have the license. I'm going to instruct you on exactly how all this works. And then at the end, I'll take questions. And I find, especially with this lead type, it works really well. And so, when I was new, I used to think like, man, it sounds like I'm talking forever. But trust me, like the client is like literally like almost like in a classroom. They're like hanging on your every word because they're being educated on how everything works. So, and then the second thing I'll say is, again, like you said, a couple of trial closes as I'm getting to the point where I'm going to ask for the business. Things like, hey, if I can find something that you're healthy enough to get and it's affordable, I always like to say it's not going to take food off the table, because I think the number one concern with today's America is like, hey, can I afford it? No one wants to feel like I can't afford to pay for it. So I just make it super clear. Like, I'm not going to recommend anything that you can't afford. Does that sound fair? And if they say, yes, that sounds fair, that's the first trial close.
Yeah.
And I love the line, and I learned this from Jeremy Lee Minor. I watch a lot of his stuff. Is, again, I need the client. I don't want to do all the work and tell them, hey, you need this, you should move forward. I want the client to tell me that, because again, they're the one that asked me for the help. I don't have the problems, they do, right? So when I ask a question like, hey, if we can find something within the budget, do you think this would be important to you? Most of the clients at this point are saying, yeah, it absolutely is important to me.
Yeah.
And then from there, I'll get into my close.
Love it.
So, just a couple things there.
Love it. Because again, a good salesperson, if you're new and you're closing, the first time you close is when you show numbers, like you've not gotten them in the habit of saying yes, right? You've closed and had them say yes three different times with them really fully understanding it. So the fourth time you actually show numbers, it's lowered the sales pressure. And at that point, they're just going to make a decision. People don't want to be sold. So it's kind of a little bit of art to it. So just follow exactly Travis's script one, two, three, all the way through. And have the trial closes in there, get to the end, use the same exact closing line, and it should help you have a lot of success early and often with working these leads.
Yeah.
Um, what do you generally spend on a weekly basis with StrongPoint?
So I'll usually get at least one lead order a week.
Okay.
So I think like 25 of their leads is like $1,200.
Okay.
Again, I would spend more, but I have some other lead sources. So me, if I'm a newer agent, right, I'd probably get about 25 to 50 a week. If that's your only lead source, I would recommend diversifying, because that's just smart to do in the business. But yeah, me personally, I buy 25 like clockwork every single week. But I love it because it's like a guaranteed, I know I'll get 25 high quality leads. Again, people that literally know exactly what I'm calling for. And they definitely want my help. And I think the other thing I really do like about the strong point leads specifically is they're just not resold.
Yeah.
So what I mean by that is, like, I never have to worry about another agent coming behind me and replacing my business. Or I never have to worry about, hey, I'm the second agent that's trying to now undercut the first agent. Again, whether that's right or wrong, it's up to you to decide. But I don't have to feel that way at all. I'm the only agent that got assigned to them, and it doesn't matter how long. Again, don't let the lead sit there too long, because top of mind is key. But I do like the fact that, hey, I can buy 25 leads, and I'll know that once I reach all 25, I'm the only professional they spoke to or will speak to. And I think that's for persistency, I think that's huge, for credibility. Again, so even for a newer agent, right? Like, you don't have to worry about having to, step over another agent. So I think that's huge.
Love it. So I think a big thing is obviously for new agents is reaching out to people that are where you want to write, right? As far as like if someone was protecting 10 families a week, I was reaching out to them, trying to pick their brain. If you don't mind, would you mind sharing like your Instagram uh name so people can find you and reach out to you?
Yeah, Instagram is T Vince 19. Or it might be T.Vince19. Sorry, let me figure out which one it actually is. But
Okay.
yeah, you can hit me up anytime on Instagram, and then I'm on Facebook as well. Or you can reach out to me personal cell. I'd be happy to give some tips, or at least share with with an agent, what's working for me. Again, I'm not God's gift to insurance, that's by far. But I think I have, through trial and error, found a few things that's working for me, and I'm happy to pass that along too if anyone needs it. Cell number 603-264-9038. And again, either way, Instagram, Facebook, or you can hit me up, just text me, and happy to help.
Awesome, man. Well, I appreciate you jumping on. I think this will be a huge help to a lot of agents. So, thank
Yeah.
you.
Yeah, man. Thanks for having me on.